Blindsided, Ginnie Mae announces an imminent deadline to abandon the LIBOR index. Here's an accounting of the home equity conversion mortgage and the LIBOR.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Last Monday, Ginnie Mae, the government bond insurer, declared that the agency will no longer be accepting any mortgage-backed securities, or MBSs, which are attached to the LIBOR index. The policy effective date for the home equity conversion mortgage is January 1st, while traditional or forward mortgage-backed security restrictions, those go into effect January 21st, 2021. Our industry's adoption of the LIBOR actually began with Mortgagee Letter 2007-13, issued on October 12, 2007. It permitted FHA to insure HECM loans using either a one-year LIBOR index for the annual adjustable loans and the 10-year LIBOR swap rate for the monthly adjustable HECM. By 2008, most of our lenders had switched to the new index, but during that transition, trouble was actually brewing for the LIBOR. Between 2003 and 2013, global regulators, after investigations, advised financial institutions to move away. The troubled LIBOR faced even more scrutiny in 2012. That's when Barclays Bank entered into several criminal settlements, which revealed fraud and rate manipulation by colluding banks. The legitimacy of a benchmark lending and financial institutions used across the globe was officially tainted. Now back to just last week. While Ginnie Mae's move away from the LIBOR index had been long anticipated, the announcement of the fast-approaching deadline caught many by surprise, as the transition to a new interest rate index had not yet been finalized for the home equity conversion mortgage. In July 2017, Reverse Mortgage Daily reported on our industry's plans to work to implement a replacement index, that is before the changes actually take place. In May 2019, Michael Drain, Senior Vice President of the Office of the President of Ginnie Mae, discussed the impending index change at NORMLA's Eastern Regional Meeting in New York State. The amount of time we have to figure everything out is less assuring the more you look at how complicated this problem is. Now, Drain is the individual who headed the effort to work with lenders who issue securities in both the traditional and reverse markets. Now, during Reverse Mortgage Daily's July 2020 summer virtual meeting, New View advisors Michael McCulley said our industry stakeholders were working to take, quote, active steps to prepare for the sunset of the index. And he added this: our principal concern is that we want our industry to adopt the same widely recognized liquid, mainstream global index or set of indices that the rest of the mortgage industry will use. We want to be lockstep with the rest of the financial markets and do not want to end up having a different index than the rest of the financial markets and financial world uses. That is our overriding objective. According to a recent column in the M Report, traditional mortgage lenders have actually been moving away from the LIBOR rapidly, in fact, much more quickly than reverse mortgage counterparts. Bonnie Sinek writes this in the American Banker's Asset Securitization Report. Due to historically low fixed rates and plans to phase out the LIBOR, traditional ARM securitization at Ginnie Mae has declined notably in the past year. It was $12 million in August, down from $68 million during the previous month in the year. In comparison, newly securitized reverse mortgages continue to run at a rate of $500 million to $600 million per month on average, according to capital markets consultancy New View Advisors. It appears there is quite a difference when it comes to volume. Now, what transpired between the ongoing discussions between Ginnie Mae, HUD, and the Federal Reserve's Alternative Reference Rates Committee and our industry stakeholders, which led to a sudden deadline? Well, that remains to be seen. But the good news is that our industry has a long established history in using the CMT, if that is our index, the constant maturity treasury rate. And in addition, the HECM's adjustable rate note actually states if an index is no longer available, one can be prescribed by the Secretary of HUD. To date, no official rate index has been announced by the Department of Housing and Urban Development. In its August 4th letter to the Consumer Financial Protection Bureau, NORMLA did appeal to use an index that is widely adopted by HUD, which has a similar historical rate and fluctuations as the former LIBOR index. So we're not going to be disadvantaged with a different indice. So what are your thoughts on the sudden deadline, and what impacts do you see in our marketplace or even pricing? Feel free to share your thoughts in the comment section below, and please share this video with other reverse mortgage professionals. You can do that by using the social media links here on this page. If you're on YouTube, be sure to click on the subscribe button. That way you never miss an upcoming episode. Thanks for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at Hecken World. I'm your host, Shannon Hicks, signing off until next week.